Big news just hit the wires. The Shanghai Futures Exchange is cracking down hard on silver trading, jacking up margins and limits to cool off the heat. Is this the smoking gun for a massive physical silver shortage? Hey everyone, welcome to Market Truth, where we cut through the noise and get to the real facts. I'm your host, and today on this Wednesday, February 11th, we're diving deep into why silver is exploding, what the big exchanges are doing about it, and how you can protect yourself. If you're new here, this channel is all about honest market insights. No scams, no paid promotions, just the truth. Hit that subscribe button right now for Market Truth, so you never miss an update that could save your portfolio. Let me make this clear from the start. I will never ask you for money. No signals to buy, no courses, no mentorships, nothing. If anyone uses the Market Truth name to sell you something, it's a fake. Report them fast. This is education on market battles, not advice. Always protect your money, check everything yourself, and stay away from easy win promises. They're usually traps. For those catching up, our last videos talked about how some channels face suppression when they speak real truths. If you missed them, go watch now. They show why staying alert matters. And if you get value from breaking down these market moves like we do here on Market Truth, drop a comment below. It doesn't have to be fancy, just say you're watching and paying attention. Yesterday, thousands of you showed up strong, proving that when people unite, the system can't ignore us. So comment now. Let me know you're here and ready for more truth. Now, let's jump into the fresh data. As I record this on Wednesday morning, silver spot prices are hovering around $83 to $85 per ounce in the West, with futures a bit lower. Over in Shanghai, spot is trading at a premium, about $3 to $4 higher than Western prices. That's the market telling us physical silver in the East is worth more than paper bets in the West. You can check this on public sites like the Shanghai Gold Exchange. It's all there for anyone to see. Here's the big story everyone's missing. In the last day or so, silver jumped another 2 to 3%, adding billions to its value worldwide. From last Friday's low around $64, it's up over 30% in just 5 days. That's wild swings, up fast, then slammed down, now bouncing back. While this was happening, the Shanghai Futures Exchange suspended more trading accounts for breaking rules. In the past week, they've hit at least 6 groups, and reports suggest more. Total in recent days? Around a dozen or so getting restricted. When have you seen a major exchange do that so fast? Look up Article 16 in their rules, it's public. This screams they're worried about too much trading pressure. The ones who dig into this know what it means. Those who brush it off without checking will learn when prices climb higher. Meanwhile, over 800,000 ounces of silver left the COMEX vaults in one day recently. March contracts are rolling forward faster, which might mean enough metal for deliveries if it keeps up. But that's a huge maybe. Right now, open interest is about 68,000 contracts. That's 340 million ounces of paper claims. Registered silver in vaults? Around 103 to 113 million ounces. Do the math. That's about 3 to 4 paper claims for every real ounce. COMEX reports this daily. Go verify it yourself. Don't just believe me. Plus, open interest dropped by a couple thousand contracts, showing some short sellers are covering bets. Bloomberg reported gold demand booming in Hong Kong before Lunar New Year. People are grabbing small bars and coins as gifts, with trading way up from last year. Sounds like normal holiday buying, right? But dig deeper. They said supply issues, especially in silver, are worrying folks about keeping the rally going. Read that. Supply constraints in silver, straight from Bloomberg, not some blog. They're hiding it in the story, but if you read fully, you catch it. Bloomberg also ran a piece on China's silver squeeze, holding strong even as prices level out. Mainstream media is finally admitting what's been clear in the numbers for months. Analyst David Jensen put out fresh work on silver running low. He says Western vaults are draining fast, with lease rates spiking on US and London exchanges. Metal is heading east, and vaults everywhere are emptying. Years of using more silver than we mine means prices need to jump a lot to bring more supply. On volatility, he warns, people worry about silver's fast rises and swings, but they haven't seen the real action yet. His full report is out there with sources. Check it. Now, tie this to the bigger world game most ignore. China's slice of U.S. imports hit a 26-year low. They've been pulling away for 5 years, rerouting supplies so tariffs hurt less. While doing that, they're controlling key metals exports, stockpiling, and building that Shanghai premium, now at $3 to $4 for silver. Physical trades higher in the East than paper in the West. That's the market yelling that real metal and paper are splitting apart. Check Shanghai Gold Exchange data daily. It's free. Look at silver versus gold. Available silver is way scarcer than gold, maybe 1 to 100 in economic terms. But we need silver more for industry: solar panels, electric cars, AI centers, 5G, military gear. Mining can't keep up. Folks switch to silver not just because gold's pricey, but because silver's gains crush gold's. The gap between paper prices and real delivery is getting obvious. True price isn't New York screens. It's what you get when demanding physical, and exchanges are tightening rules. Bank of America added U.S. material stocks to their bubble risk list, along with gold, silver, and South Korea's index. They use a weekly bubble indicator spotting frothy spots. They warn AI innovation could make markets more bubbly and unstable ahead. So big banks flag bubbles in metals. Sell signal? But same week, Wells Fargo hikes their 2026 gold target to $6,100 to $6,300. That's over 20% up from now. Why? World risks, market shakes, strong central bank buying. They call recent gold drops a good correction after sharp rises. Spot gold down over 10% from January high, from profit-taking after 15 to 20% gains. Two top banks, opposite signals, same week. Shows even pros are mixed up. Bubble or breakout? Depends on your view and what you measure. Step back. S&P 500 versus gold has tanked 60% over 25 years. Decades of smart folks innovating, top companies making record cash, yet under gold, which just sits there. No profits, no growth, but beats the U.S. stock market. S&P earnings yield near 100-year lows, only lower in dot-com bubble. Maybe the bubble's in stocks, priced in weakening money, not metals. But let's be fair. Here's the downside, because truth means both views. Silver 1-month lease rates dipped to about 2.7% after wild 4 to 6% daily swings. That could mean short-term fixes or temp issues, not long shortage. March COMEX might have enough if rolling keeps up. We've seen doomsday talk fizzle when positions close or roll. Shanghai premium at $3 to $4 is high but not new, happened before. Bank of America's bubble warning isn't junk. Assets rising too fast can crash hard, even with good basics. History shows it. Momentum flips. Price can ignore facts up or down. This is market education, not tips. There are real ways paper markets keep prices low for months or years. Big shorts, derivatives, tricks, bank moves. The 2020 JP Morgan $920 million fine proves metals rigging is real, court admitted. But it also shows rigging can last decades. They paid, then kept going. If you wait for fair play, you might wait forever. Paper tools outlast most traders' cash. But key, those down delays assume paper controls price finding. That's cracking now. SHFE's margin hikes and limits from late February, global vault drains, account suspensions, ongoing Shanghai premium, Bloomberg on shortages. All say physical is breaking from paper. You can make endless paper, but not real metal. When buyers want bars, not cash, paper breaks. That's building. Daniel Oliver from Mermican Capital says gold could hit $12,595 if dollar crashes. His view? Dollar end is coming. Government defaults or prints to buy debt, killing the buck. Not some YouTube rant, a money manager with real funds. Agree or not, debt paths and bank books make it hard to fight. Silver, with industry pull from solar, cars, AI, plus money demand, supply gaps, world splits causing stockpiles, it's the high-risk play on that. When gold jumps, silver jumps harder percent-wise. History shows it, and this cycle's 30% bounce in days proves it. What to watch? SHFE rule changes late February. COMEX March deliveries. Daily Shanghai premium. Silver lease swings. These show if physical wins or suppression holds. Check SHFE yourself, official changes. COMEX data daily. Bloomberg Hong Kong story and silver constraints. Bank of America's bubble method. Don't trust me or media. Check sources. Diggers who pull reports see the buildup. They get why suspensions matter, what 3 to 4 to 1 ratios mean with delivery push. Waiters for comfy TV explanations buy high later, asking why no warning. Warning's here. Data's public. Sources checkable. Are you a checker or dismisser? Invest smart, not excited. That's Market Truth. Subscribe now if you want more like this. Comment Market Truth below and share your take. Is silver shortage real or hype? Let's build this community. Hit like if this helped. It beats suppression. Stay sharp, folks. Truth wins.